Well, good afternoon, everybody. This is Ron Wheeler here. I'm joining you from my beautiful living room here in my house. I'm just kidding. That's totally like a made-up background. I'm in my office with a gray screen with a gray foam wall behind me. It's kind of like if you could picture like a room where they put mental patients, that would be me. All right. Anyway, um, welcome to today's presentation, the 5 keys to generating income with options. Do me a favor, as you're joining us, if you can just let me know, say hi, hey Ron, how you doing? Hit the like button on Facebook, share it with your friends, anything you can do, that would be appreciated. But most importantly, do me a favor, let me know that you're watching. That way I know that the stream is working, I know that everything is working, and we are broadcasting properly, and you can hear my voice and my comments and everything. All right, I see thumbs up. I see a couple eyes on me here. All right, good deal. Rick, I appreciate it. And Casey, appreciate that as well. Good to have all of you with us. We'll start here in, like I said, just a few minutes. As we do these live streams, I kind of like to wait a minute or two before I start the presentation, just to kind of let everybody get in there. Hey, Mark, good to have you with us as well. And just to let everybody get in, find the stream, get it set up, and do all that great stuff that I know that, so I know that you're watching and everything is going well. Good deal. I appreciate that as well. Good deal. Rick and Aaron, welcome to you. Tyre, welcome. And I see, let's see. All right, cool. And KC, good to have you with us as well. So what today is all about, it is about the 5 keys to generating income with options. And while we're waiting for just, again, a couple more minutes to start the presentation, one of the things that I like to talk about is, what is income? You know, what is the difference between a quote unquote income trade and just buying 100 shares of stock or selling 100 shares of stock? I look at income trading or income investing as a paycheck. Now, when I go to work, when I work here at VectorVest, at the end of 2 weeks, they give me a paycheck. I know that as long as I still have a job, that paycheck is coming in 2 weeks. Okay. It's a very high probability thing. In fact, it's 100% probability. Now, I wish I could trade with 100% probability, but I know that I can't. But what an income trade is all about is about trading with a built-in probability. Now, I'm not talking about a great indicator or a great study, some kind of cool trading system. I'm talking about making a trade using options where probability is built in to where you can make money whether the stock that you choose goes up, down, or sideways. That to me is an income trade with this. Okay, so let's do this. Let's go ahead and get started. And as you see the presentation, if you have questions or anything like that, feel free to shout them out, put them in that chat. We'll take a look at them. And, you know, I've got a full team with me. I've got quite a few folks here from VectorVest that are familiar with this. They will help you out. I'll help you out. We'll have a Q&A at the end as well. And we'll go ahead and kind of show you the process of those 5 keys to generating income. And I always like to start is, why is this such an important topic? You know, I've always kind of haphazardly said, you know, oh, we got to beat inflation. And inflation was fine when it was 2%, right? Inflation's not 2% anymore. It's a lot higher. Generating another stream of income is important to help us maintain our lifestyle. Now, I'm a big believer in results. I'm a big believer in proof. One of the things I do here at VectorVest is I run a service called the Ultimate Retirement Solution. What I do with my clients every week is we do live trades. I trade my own account and I do trades with them based off of this income approach. So what I wanted to show you guys so far this year is this is my results through September. Now, I trade essentially with $100,000 in capital. And for the year so far, I have a $26,000 or a 26% return with a 62% win rate. That's what it's all about. It's about getting that win rate more than 50%, keeping your average winner and your average losers as close as you can, and really getting those trades in your favor. Now, what you can see here is that out of the 10 months of this year, I've made money in 8 out of 10 months. April, I had drawdown. July, I had a little bit of drawdown. August and September, I really cleaned up, just like I did in February and March. But on average here, I'm making about 2.5% per month so far, which is a pretty good goal. I'd like to make 3%, and the year's not over yet. I still got October, November, December to go as well. So I did 130 trades this year. Okay, 130 trades. So I'm averaging about 10, 12 trades a month and 26% return so far. And this is not abnormal. This is the average. Okay. The average goal here is about a 2.5 to 3% monthly average return. So this isn't something that I'm finally doing very well. This is something that I've been doing for a very long time, using what I'm about to show you. Now, I mentioned earlier that my name is Ron Wheeler. I'm the options trading manager here at VectorVest. And I mentioned my job. I run the URS program, or I'm one of the co-leads of the URS program, where I focus on income trading using options. I've been trading now for 25 years. So I've been doing this a long time. I've been a futures trader, a futures day trader. Now I'm solely into options because ultimately options are the path of least resistance. You know, options trading is a lot easier than futures trading was. I was still successful at it. I was going to day trader for a long time too, but options trading allows me to spend less time trading. It gives me that statistical edge, and I can make just as much money as I was before. That's why I like trading options now. I made the switch probably about 12 years ago, and I've been trading options pretty much solely through the last 12 years. Now, we're going to dive into that 5-point system that generates income using options. Now, along the way, I'm going to show you a lot of the mistakes that traders make and a lot of options traders makes, and I'm sure how you can avoid them. And I'm sure that some parts of the system are going to surprise you because they go against what most investors have been taught. Okay, so I'm going to show you exactly how this works and how you can do the same thing that I've been able to do year after year. And again, I like to prove it to you. That's why I showed you what we're doing this year, because I want you to understand that this is something that is real. Now, most important, stick around to the end. We're going to raffle off a $1,000 option course at the end of today's presentation. So make sure you stick around to the end. Now, I have a question for all of you. What one word, bring it down to one word that describes how you feel about options. Just type that into the comments there. One word that describes how you feel about options. I like to get a little bit of feedback into this, and it's always nice to see what people out there are actually thinking about options. You know, one of the things that I never traded while I'm waiting for the comments to come in, I can tell you this. One of the things that worried me in options, when I first started trading, I was a futures and commodities trader. Options worried me because I was always taught stay away from options because, you know, you could do everything right in the trade and still lose money. So I thought options were terrible. I never touched options until, you know, a decade into my trading career where I knew how to do it properly. KC, you mentioned clueless. Jim, interested in options. Good. I like to see that. Mark, income, adjustable. All right, true, cool. You guys are very optimistic about this, and that's a great thing. I love it. Now, Casey, you said clueless, and that makes sense because a lot of people think that options can be scary. And again, I was that same approach when I first started. You know, I thought options were scary. I heard all the horror stories. Well, you know, I did these trades, and I wiped out 30 of my winners, and, you know, the market did exactly what I thought it was going to do, and I lost money. It was very, very scary to me as a new trader. Rick, that's a great one. Gambling. Right? So these are good. These are things that have, and there's a lot of misconceptions about options. And we're going to talk about that today. Now, we're going to talk about the 5 keys to using options successfully. And then not only using them successfully, but then also making money and creating income. Now, the first thing that you have to do, if you want to make money, if you want to have the returns and you want to have the accuracy percentage that I do, the first thing you need to do is not be a buyer of options. You don't buy calls, you don't buy puts. You become an option seller. So let's take a look at this. Now, there's 3 main parts of options that we're going to talk about right now. So when you think of an option, there are 3 parts of it. There's the expiration date, there's a strike price, and there is an option premium. In other words, the price that you pay or receive for an option. Now, for that, there's buyers of options and there are sellers of options. Now, the expiration date works against you as a buyer, okay? Basically, You have to be right in your direction. If I buy a call, the stock has to go up before my option expires. All right. That works against you. That's why people can say, oh, I bought a call. I wanted the stock to go up. It went up, but it went up after I expired. So I lost money on the trade. Then you have the option strike. Now, as an option buyer, you need to overcome that strike. So if I have a $100 stock and I buy a 105 call, I'm not really going to make money unless the stock goes over 105. You have to overcome the strike price to make money. Now, the premium is kind of a dual thing here. When you buy an option, let's say you buy a $100 strike for $2. That premium, you have to pay it up front. Not only that, you have to also overcome that. So if I pay $2 for a $100 option, I'm not really going to make any real money until the stock goes up at least $2 to overcome not only the premium and the strike price. Now, that's a lot of negative on that. Now, if we flip it over to the seller, that expiration works for us. It's like a ticking time bomb, right? That expiration and that time decay ticks and ticks and ticks every single day. That's money in my pocket as an option seller. Strike prices are easy to avoid. Stocks at 100, where do you think it won't go to over the next 3 weeks? The premium, we seek out those juicy premiums and we become a receiver of that. We're going to sell options that are very, very premium rich. I hesitate to use the word expensive, but premium rich. Okay. Now, let me ask you another question. Let me get a little more feedback from you. Have you been, for those of you that have traded options before, have you been more of a buyer or a seller of options? Those of you that have done this type of options trading before, buyer or seller? Now, for me, and again, I'll wait for your comments and just give you kind of like my answer to that question. When I first started trading options, I was a buyer. I was like everybody else that, oh, you think a stock's going to go up, you buy a call. You think it'll go down, you buy a put, right? But that is the way to not consistently making money. And I had basically the same problem. It was inconsistent. Mark, you mentioned both. Okay, that's good. You're on the right side of the trade. Now, I'll be honest with you. I've done both too. I still buy occasionally. And then, Jim, you mentioned both, but mostly buyer. Right now, I'm about 95% seller, 5% buyer, because there are times when buying an option is pretty okay. The problem is, since statistics aren't on your side, it's better if you do the buying a much, much lower percentage of the time. Okay. Now, being an option seller, and then Tyler, you had mentioned buyer. Now, being an option seller, okay, this is what allows us to get that high probability of success. You can average over the long haul over 70% winning trades. That's really the beauty of what we can do. Okay. We can average a higher percentage. Now, the way that we do it kind of brings us into key principle number 2. You need to avoid strikes. All right. Now, this is something that's way against me. I'm a bowler. I bowl as on my Thursday night league. That's the last thing I want to do is throw a gutter ball. But what we need to do as an option seller is we need to avoid strike prices. Now, I'll explain that a little bit more in detail here. Option buyers make a lot of mistakes around this. And one of the things that they do is they choose very unrealistic strikes. All right. So let me explain how this works. You got a stock. And it doesn't matter what stock it is. This happens to be Lockheed Martin from a couple of years ago. It doesn't really make a difference, right? A chart's a chart. Let's say that you think Lockheed Martin is going to go up in price. It's $216 on this graph right now, and you think it's going to go up. Well, a lot of traders and a lot of option buyers, what they'll do is they'll go out way up here and they'll buy a call, $230. Now, I want you to think about what we talked about earlier, right? When you buy an option, you have to overcome 2 things. Price of the strike, in this case, $230, and premium. So if I buy a $230 call, I'm not going to really make any money unless the stock goes over $230, which is a very low percentage chance. And then even if it does, I also have to overcome that premium. Now, what we are going to do as option sellers, we are going to be selling those options where the stock has a very little statistical probability of getting hit. So we're going to go out there and we're going to be the facilitators. We are going to sell people calls that have a low probability of the market hitting that price. And it's the same thing when we go underneath the market too. We're going to sell puts where we think that the market, based on statistics, cannot get to. All right? It's all about statistical probability. Will the market that's trading at 215 trade up to 230, or will it trade down to 200? We choose options that have a very low probability of that strike price being hit. Now, let me ask you guys a question again. Have any of you ever bought a cheap option hoping for a big return? You know, you look at that Lockheed Martin and you say to yourself, all right, well, you know, it's $216. I'll buy that $230 call. It's only going to cost me $1, right? Very low risk. Worst case scenario, I lose $100. No big deal. But man, if this stock explodes, I can make $1,000. I can tell you this. Yes, I've been very, very guilty of that myself. And that is why I've also had low success at this. You know, I'm going to tell you a story. One of my colleagues, and this is a long time ago, he had done this, right? He was buying very inexpensive, out of the money, strike prices way away from the stock. He finally hit the lottery of lottery. He bought a Ferrari. He was doing great because one of his trades finally came in. 5 years later, all that was gone. Because it's not a system that's going to make you profits consistently. It just doesn't work. You have to not trade and play the option lottery game. What we are going to do is be the seller of an option that has a very little chance of getting hit. Okay? Now, if what I'm talking about so far looks pretty interesting to you, download this action guide. Go to www.vectorvest.com/FB1. We'll put a link in the chat window for you. And what that'll do, it's going to take you to a website that looks like this. It says the option paycheck system, free checklist download. Click on that download now button, and you can download our very, very quick checklist. Just put your name, your email, and your address, say, I want my checklist, and we'll send that out to you. Now, what you can also do, okay, about 5 minutes, that'll come. And then what will also happen is you can claim your spot. We're going to be doing some sessions in the next couple of weeks here for how to generate 3% per month with up to one option trade a week. So this is kind of the bread and butter of what I do as an option trader. And again, this is the cool thing about this. I absolutely love my job because I practice what I preach. I don't just come on here and say, hey, look at this trade. It's awesome. I trade these things. I trade these things in front of people. I put my money where my mouth is. You know, I took 4 trades with my clients on Monday. I took a trade today, 2 trades today with my clients. I actually put this to work and actually really, really trade this stuff. So that's the beauty of this. All right, now, and remember, there is a raffle for one of these classes at the end of today's session, so keep that in mind. All right, now let's talk about this, expiration, right? We talked about, you know, the strike price, they've got to be away from the stock. Let's talk about the expiration. When do we sell an option? When do we want it to expire? And again, this gets back to a mistake that option buyers make. And what happens is they buy options that expire too soon, okay? It's like grocery shopping. You go and buy a steak, right? My wife calls me and says, hey, pick up some steaks for dinner tonight. I go to the steak rack and I see a filet mignon. One is $30 a pound. Well, with inflation, it's like $40 a pound now. That one expires next week. I can take that steak home, put it in the fridge, and eat it next week. I've got plenty of options for that, no pun intended. Or to the left of it, I see a filet mignon for $20 a pound. But the kicker is I got to eat it tonight or it's going to expire. Okay? My wife asked me to bring home steaks for tonight. Why wouldn't I just get that discounted steak and just eat it tonight? That is all about choosing the correct expiration. Now, if she said, hey, we're having dinner on Friday with some friends, pick up some steaks for Friday, I'm not going to buy that discount one. I need the expiration that expires next week. I can't choose that discount one. Or maybe I can just feed that to my guests. I'm just kidding, totally kidding. Okay? Now, options are the same. So when you have an option that's very, very close to expiration, what you end up seeing is you see options that have very, very little value. What happens over time is as options get closer and closer and closer to expiration, the time value of that option decays exponentially. Okay. It can take, if you have a 6-month expiration option, over the 145 days, it can take 145 days to lose half its value, but it loses the rest of that value in the last 45. Okay. What we want to do is pick out a nice little window here from 21 to 45 days to be a seller. Now, why 21 days? And this is an interesting thing. When I place a trade, my typical trade lasts 7 to 10 days. Okay. My typical trade lasts about 7 to 10 calendar days. So if I take a trade on Monday, historically, I'm going to be out of it by the following Wednesday. A lot of people look at that and say, well, Ron, why wouldn't you trade a 10-day option or a 14-day option? Well, there's a balance point, right? We need to sell options that have enough premium so we don't have our losses too great. We don't want to sell an option way too much with about too much time because we want to make sure that time decay is working for us. So we got to pick that beautiful window of 21 to 45 days. This is where we want to sell all of our premium. Now, if you looked at all of my trades right now, again, I mentioned that I have 5 trades on right now using this approach. All of my trades expire between 21 and right now 37 days to expiration. Okay. Well, I think it's 37 days. They're all using November options. So yeah, 37 days to expiration. All of the options that I sold are in that 21 to 45 day window, but I expect to be profitable on my trades next week. Now, let me ask you another question. Have you ever bought an option only to watch it expire worthless? Now, again, this gets back to that time of maybe you're buying options that expire too soon, or maybe you're buying options that are way what we call out of the money, and the stock doesn't have enough time to move to your price. So you buy a $230 call on a $200 stock, and it moves to $230 3 months after your expiration. Okay, we got to be very, very, very careful of that. We do not want to buy options with those short expirations. We also don't want to sell them either. We want to make sure we hit that sweet spot perfectly. Now, as an option seller, right, we want to make sure we're selling in that 21 to 45 day window. All right. Now, remember, stick around to the end. We've got a chance to win a $1,000 option income course. Okay. So stick around. And the cool thing is I will show you from A to Z how to put this into your portfolio. You'll love it. Now, the last thing I want to talk about is this. As an option seller, we need to trade with what we call an insurance policy. Now, one of the biggest misconceptions about options is their risk. Options were actually created as a way to mitigate risk. So when you trade or when you sell an option, you should not be doing a risky trade. One of the biggest fears and one of the biggest things people tell me is, Ron, you're teaching this concept of selling options. And, I've tried this before and, I made money for 4 months straight. And all of a sudden, one bad trade came in and it wiped out all my gains. I hear that a lot. Now, that is not part of a good option selling system. Now, what I'm going to do real quick here, I'm going to go back. Give me 1 second. I want to go back to my results for this year. These results are typical, by the way. Here's what I want to make sure you understand. Take a look at my average winning trade of $804. Take a look at my average losing trade of $798. This is controlled. People always ask me, Ron, how do you take trades and how do you make sure that you don't lose 4 times what your average winner is? It's really actually very, very easy. I don't take trades where that could happen. It's as simple as that. It's not that difficult. Now, you're going to hear me use this analogy a lot as I, teach you about this. If you come to one of our classes here in the next couple of weeks that we're doing, you're going to hear me use this analogy a lot. It's a really easy analogy. If I jump off the roof of my house, there's a really good chance, at the very least, I'm going to break my legs. I have a really high roof. Okay. If I jump off the house, I am going to break my legs. Now, how can I mitigate the risk of breaking my legs? Maybe throw a mattress down. Okay. Maybe put a bunch of boxes down there to break my fall. Maybe one of those big, like whatever those things are called that they use for stunts, right? But you know what the easiest mitigation of doing that is? Don't jump off the roof of your house. If you don't jump off the roof of your house, your chance of breaking your legs goes to 0. Do you know how you sell options and not lose more than your average winner? Don't take trades that could cause that to happen. The beautiful thing about being a good option seller is that your risk is all known up front. So let me expand. So our paycheck system is what we call this. What this does is it reduces your risk, and it reduces the risk before you even open your trades. Okay. So when I say you're going to be an option seller, those of you that may have sold options before, you may understand this term of being a naked option seller. Basically, that means you're selling a call, selling a put, and that just leaves you with a ton of risk, right? A ton of risk. If you sell a put and the stock tanks, you are going to lose 10 times more than your potential gain. And vice versa. If you sell a call and all of a sudden the stock just goes ridiculous, you're going to lose 10, 15 times what your gain is going to be. First and foremost, to control risk, don't sell naked. What we've got to do is shrink our risk down to a very, very small amount. So let me explain how this works. Okay. This is a typical stock that we would like to be bullish on. Now, we talk about bullish right now, and I'll give you an example of a stock I'd want to be bearish on too, by the way. This is a beautiful bullish graph. We would want to be bullish on this. So as an option trader, what people would generally do, if they do it relatively correctly as an option buyer, they may go out and buy an option with the strike price of their option very, very close to the stock price, right? But that's not what we're going to do. We're going to be an option seller. So if we think that a stock is going to go up in price, we sell a put underneath the price of the stock. So the price of the stock is 137.50. I might go down to 135, 132.50, 130, and I might go out there and sell a put. Now, when you sell that put, you're going to collect premium. Okay? You're going to collect some premium. In this example, let's say we get paid $200 to place this trade. Now, as an option seller, this is not like selling your car. So if I sell my car, I sign the title over, I call the insurance agency, cancel my insurance. I'm done. The risk is over. Somebody else takes my car. I'm done. I don't have any more responsibilities. When you sell an option, it's not like that. Selling an option is very akin to being an insurance person. I pay my car insurance every 6 months. In June, I write a check to my car insurance company for $1,600, and they insure my cars for the next 6 months. If I have an accident, they are going to cover the damage of my car. If I don't have an accident, they get to keep the premium, and they're very happy people. Options are very similar. When I sell an option, I'm writing a contract to perform a task. The goal is for me not to perform that task. And let me tell you this much. In 15 years of doing this, I've never actually had to perform that task. So you'll never have to. But when you sell an option, you are taking on some responsibilities. Okay? And that responsibility leaves you with a lot of risk if you don't buy insurance. So what we're going to do is we're going to take some of that premium that we collected, and I'm going to buy an insurance policy on the trade. What that insurance policy does is it reduces my risk to a small amount. And that policy does cost me some money. All right. I get paid $200 when I sell the option. I buy an insurance policy against it for $100. I'm still going to get paid $100 to place this trade. Now, that doesn't sound like a lot. That's one contract. But if I did it for 10 contracts, I would have a potential $1,000 gain. Now, the beauty of this is, here's what this trade does. All right. I think that this stock will go up. If it goes up, I'm going to make money because as the stock goes up, the price of my options decline and I start making money. If the stock goes sideways, I'm still going to make money because the price of the options will decline because time decay sets in. And as long as it stays above 135, okay, I can still make money on the trade. That's the beautiful part of how this works. So what we want to do is we want to take credit spreads that have a built-in protection plan. And I'll show you exactly how that works. But in this particular case, The most I could lose is $5 on this trade because I sold an option at 135 and I bought an option for 130. My risk on this trade is only $5. Okay? I've limited my risk down to a ton. Now, again, if this sounds like something that's appealing, get that free action guide. We'll put a link in the chat, www.vectorvest.com/FB1. It'll take you right to this website here where you can download that checklist. Just click on the blue download button and then give us your email. We'll send you an email with that checklist. And then also don't forget to reserve your spot in next week's class that are upcoming. I'm sorry, I don't want to say next week, but in the upcoming classes that we have that kind of go into this a little bit more in detail. This is kind of a sneak preview. Now, the fifth principle of what we talk about is you need to take less profits because ultimately you make more. You ever hear that expression, half a loaf is better than none? If you're starving and somebody gives you a half a loaf of bread, are you going to just say, no, I'm going to hold out for somebody that's going to offer me the full loaf? You know, my little anecdote here worked much better, by the way, when I did these classes live, when I would fly to a city and do this. What I would do is take a $100 bill and throw it on the floor. And I would say, free $100, who takes it? And people would raise their hand and say, well, I'll come up there and take it. I said, great, you're doing the right thing. Now, how many of you would wait and see if I threw another 100 on the floor? And everybody would start laughing. Ha, 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 ha. I said, yeah, you're laughing at it now, but you don't laugh when it comes to your trading. Oh, I'm up $100 on this trade, but I think I can make 500, so I'm going to hold on to it and see what happens. What happens to it is as you hold on to things longer and longer and longer, your opportunity to take that $100 or take that loaf of bread goes away. And that really comes down to emotional trading. Have emotions ever hurt your trading results? I think that everybody to this can say yes. Absolutely. If you want to chime in, let me know. Have emotions ever hurt your trading results? Have you ever stayed in the trade because you had to make money, or you just think that this stock is going to go up just a little bit more? Have those emotions ever hurt you? Now, the takeaway here is simple. We're going to set a profit target of 50% of the initial credit that you receive. Okay? Now, here's what I want to do. Give me a second here, and I actually want to show you some trades that I'm currently in. All right? Now, give me 1 second here. I'm going to load up a trade that I'm currently in. All right? I'm going to put it on a graph first so you guys can kind of see what I'm doing here. So give me 1 second. I like to do things, live. All right. Takes me a second to get this loaded up here. All right. Now, this right here is a graph of Twilio. Now, right now, we're in a definite bearish market, okay? The market's been going down all year. So obviously right now, we are very much in a bearish situation. Now, on Monday, I placed a trade on this, okay? So let's go back. This is today's bar. This is today the 12th. This was yesterday, a Tuesday, and this was Monday. So I took the trade on Monday. And what I did is I went out there and I sold an $80 call, which is right here. And I bought an $85 call, which was right here. Now, this trade, all right, basically can make money. Now, remember, the stock when I took the trade is trading about right in here. This is where I took the trade on Monday. The stock was trading right there. Now, what this trade allows me to do, I think that the stock is going to go down. If it goes down, I will make money. But I can now be profitable as long as the stock stays below $80 a share. That's it. If it doesn't go down, I still have the potential to make money if it goes sideways, or as long as it doesn't go above $80 a share. Now, What I'm going to do, and I know that not everybody has ever seen an options risk graph and all that kind of stuff, but I'm going to try to explain how this trade works. Okay. This is the actual trade that I'm in. Let's kind of zoom in on it. Okay. Now, what you're seeing on the left here, this right here is the graph of Twilio. All right. Now, remember, I sold an $80 call and I bought as insurance an $85 call. Now, this trade has a maximum risk. And if you look over to the right, you're going to see the maximum risk on this trade, $3,550. The absolute most I can lose on this trade is $3,550. That is the max risk of this trade. Now, what would have to happen for Twilio to give me that $3,500 loss? Now, here's what I want you to follow. See this dashed line? This dashed line represents the stock price. So if Twilio rises to $105 a share, that means that I would lose on this trade $2,224. For this trade to lose $3,550, the stock would have to go all the way up to like $200 a share for me to lose all that money. So what I'm telling you is you're not going to lose $3,550. It's never happened. I've never suffered a max risk on a loss. Okay. Now, what you also can see over on the right is my max profit of $1,450. The most I can make on this trade is $1,450. Okay. Now, what you're going to see is how I take these trades and manage them essentially. I mentioned in the slides, let's go back to that slide, set your profit target for 50% of the initial credit. So in this particular trade, all right, in this particular trade, I have a $1,450 max profit, $1,450 divided by 2. I'm going to try to make $725 on this trade. I want to profit $725. Oops. All right, now, I know what you're thinking, but now it's getting worse, Ron. Now you're saying you only want to make $725 and you have a $3,500 maximum risk, but you don't. All right, because there's two ways I'm going to manage this position. I'm going to take profits at $725. Now, where does the stock have to go for me to get profitable? Follow this little dashed line. For me to get profitable on this trade, the stock's going to have to trade down to right around $62.67. So I know it's kind of hard if you've never seen this type of graph before, but what you're seeing over here is the profits of the trade, okay, as the stock goes down. So to get to $725, the stock's going to have to move down to about $62.25. Basically, it's going to have to go down to about right in this area right here. So we're already getting close to it. That's why you can see over here, I'm already up $410 on this trade. Okay. Now, Ron, why don't we want to profit all $1,450? Well, very, very similar to how that max risk works. For me to make all the money on this trade, the stock's going to have to drop to like almost $40. Okay. Look at the big difference in drop to get from my 50% profits to 100% profits. Think of how long you'd have to stay in the market or that stock to get to that level. It's not worth it. When we've run the back testing, it's not just me. This is an industry standard thing. When you take profits on these spreads at 50%, you will actually make more money in the long haul because you will be out of the trade quicker. It's a chance to redeploy your capital. And then number two, you're going to increase your accuracy because you're not giving the stock more and more time to go against you. Now, what I'm going to also do is I'm going to exit the trade because you can do this, right? It's a regular trade. It's like when you buy 100 shares of stock. You can sell them anytime you want. If the stock happens to go up and surpass $80, I'm going to exit this trade. If I exit the trade at $80, look at what my loss is going to be on this trade. This trade has a roughly $575 loss if I get out of the trade if it passes $80 a share. They're very easy to get out of. In fact, if you have certain types of brokers, you can actually put orders in ahead of time for this. Okay? Now, this is why you can go and look at this stuff. And again, you don't have to take my word for it. Please don't take my word for it. Here's what I want you to look at. This shows you exactly how it works. $800 average winner, $800 average loser. I don't take trades, okay, that have large potential losses. I don't do it. I don't. That's a perfect example of the trade that I'm currently in right now. Okay, I've got a $725 gain with a $525 or $575 potential loss. That right there is the key to making money in this. Okay, these are, oops, I accidentally put subtitles on there. My bad. Okay, that's the key. Now, again, if this is something that looks appealing to you, and I hope it does, because again, this is something that I've been doing now for, I've made this the sole type of my trading now for over a decade. I've been doing this at VectorVest now for 7 years. I started here in 2015. I've been doing this for 7 years. We've had successful, profitable years every year doing this. It really is the cornerstone of good income. So if you want to get started, get that free action guide, go to vectorvest.com/FB1, takes you to this website, hit that download now button, give us your email address and name and everything. We'll send that checklist out to you. And then also while you're there, claim your spot. We're going to be doing some seminars over the next couple of weeks that are a little bit more in detail about this, that'll actually launch into our options paycheck class where we teach this from A to Z. Okay. This is how we get to that level of trading. All right. Now, I did mention that we were going to do a raffle. So do this. I want you guys to type in paycheck, just like you see right there. Type in paycheck in the comments and hit enter. What we're going to do is we're going to pick a name at random for everybody that types in paycheck. So now's the time to comment, please, if you want a shot at a free class. So paycheck, I'm going to give you guys about 60 seconds. Well, I always say guys. Guys to me is a universal term. I have men and women and everybody in my classes. I always say guys. So don't be offended if you're not a guy. All right, I'm going to give you about 45 more seconds to do paycheck. For all of you watching, I see lots of eyes out there. I want to see lots of comments. Keep it going. I should put paycheck in for me too, so I get a free class. Just kidding. I get all of the, it's my class, so I guess I get all the comments from it. All right, I'm going to give you 10 seconds. 9, 8, 7, 6, 5, 4, 3, 2, 1. All right, let's do it. All right, so I got everybody in there, and we are going to draw. All right, Jerry, you are the winner of our class. So good job, Jerry. And if I'm not mistaken, you got Ohio State stuff back there. Jerry, I already like you. I'm from Ohio, by the way. Some of our VectorVest folks are in North Carolina. I'm in our Ohio office. My wife is an Ohio State grad. Her father is an Ohio State grad. I went to Ohio State for my first 2 years of undergrad, so we're all Ohio State folks. So we are Ohio State fans. And by the way, that was completely random. So I don't think I just picked you out of there because of the Ohio State. So we will be in contact with you, be in contact with us, and then we will get you registered for that class. That's going to start in November, so we'll give you all the great details of that, and you're gonna really like what you see. You're going to learn how to do this, and the best part is you're going to learn how to do it for free, which is awesome. So congratulations to you, Jerry. I hope you enjoy it. All right, so if you have any questions about what I talked about, by all means, I'll give you a little bit of an opportunity to ask questions. Please let me know. And like I said, what I want you to do, if this is something that you're interested in, this again, the whole idea for what we're doing here today, this is just a preview. Go to that vectorvest.com/FB1, claim your spot. We're going to be doing a class over the next couple of weeks, a couple options there where we're going to talk about this in a lot more detail. Okay. in a lot more detail. All right. All right, great. Well, I'll tell you what, let's go ahead. I'll wrap it up because I don't see any more comments or questions coming in there. I'll go ahead and we'll wrap it on up. And then Jerry, hopefully you see that email in there too, where we just please send an email to John Marabu at VectorVest to get your free class set up. Make sure you reach out to him and get that set up. That way we know you get the class. And again, I'm looking forward to having you in that class in November. You're going to learn a lot and really get some good ideas out of it. All right. Well, with that, I'll let you all go. I appreciate you coming out. Like I said, this is something I do for real with real money every week and all year long. And for the last 7 years here at VectorVest and for the last 12, it's been a really good way to create additional income. You know, think about the market this year down, what, 20%, something like that, and how we can still be profitable in our trades just like any other year. It doesn't really make a difference. Okay. All right. Thanks again, everybody. And we will see you hopefully here in the next few weeks at one of our next paycheck events. Thanks again, everybody.